Ladies and gentlemen, it's now time to start this Sonicgroup Corporation's financial results briefing for the fiscal year ended March 31st, 2021. I'm Ida as the MC for this session. Thank you very much for coming. And today, that as we have announced beforehand, we have invited media members and analysts and institutional investors. And this conference will be streamed through the internet from our site. Executive Deputy President and CFO, Mr. Totoki, will present this financial results of the fiscal year ended March 31st, 2021. And later we have a Q&A session, and the total program is about 70 minutes. Thank you very much. We now like to turn to Mr. Totoki. Thank you very much. So this is the topics that I would like to cover today. The consolidated results for the fiscal year ended March 31st, 2021, and so forth. And the consolidated sales increased 9% compared to the previous fiscal year to 8,999.4 billion yen, and consolidated operating income increased 126.4 billion yen to 971.9 billion yen, both record highs, primarily due to the improvement of valuation gains and losses on investment securities in other income and expenses. Income before income taxes increased 392.9 billion yen year-on-year to 1,192.4 billion yen, and net income attributed to Sonicgroup Corporation stockholders increased 589.6 billion yen year-on-year to 1,171.8 billion yen. Adjusted operating income before income taxes, and net income attributable to Sonicgroup Corporation stockholders, which excludes extraordinary items, can be found on page 4 through 10 of the materials. FY20 consolidated operating cash flow, excluding the financial services segment, was 1,122.2 billion yen, approximately 2.6 trillion yen cumulative for the last 3 fiscal years, a level that significantly exceeds the target we established for the third mid-range plan. The cash flow of each of our business segment in FY20 is shown on this slide. This slide shows the results by segment. Next, I will show the consolidated results forecast for FY21. Sales are expected to be 9,700 billion yen, and operating income is expected to be 930 billion yen. We have changed our accounting standards to International Financial Reporting Standards (IFRS) from FY21. Therefore, the FY20 results I will explain today are based on the US GAAP, while our FY21 forecast is based on IFRS. As a result of the adoption of IFRS, the impact of the fluctuations in the market for financial instruments is expected to result in variances with US GAAP in the results of the financial services segment and in consolidated other income and expenses. However, since we do not incorporate into our forecast any impact from the fluctuations in the market conditions, we believe that the variance in the forecast resulting from the difference in accounting standards are limited. This slide shows our forecast by segment for FY21. I will now explain the situation in each of our business segments. First is the Game and Network Services segment. Sales in FY20 increased a significant 34% year-on-year to 2,656.3 billion yen. Operating income increased a significant 103.8 billion yen year-on-year to 342.2 billion yen, a record high for the segment. The increase in operating income was primarily due to the increase in sales of same game software network services, partially offset by an increase in selling, general and administrative expenses associated with the launch of the PlayStation 5. FY21 sales are expected to increase 9% year-on-year to 2,900 billion yen, and operating income is expected to decrease 17.2 billion yen to 325 billion yen. Now, I will explain in a little more detail the assumptions we made in the fiscal year forecast. As for hardware, supply has not been able to keep up with the extremely strong demand for PS5, although constraints on the supply of components, especially semiconductors, are expected To continue this fiscal year, our current target is to exceed the 14.8 million units we sold in the second year after the launch of the PlayStation 4. In order to meet the strong demand from our customers, we will continue to work to secure components and strive to do our utmost to produce and sell more units than target. Primarily due to improvements in the profitability of the PS5, we expect hardware and peripherals together to contribute to the same level of profit for the full year as they did in the previous fiscal year. Next, I will talk about software. Total gameplay time of PlayStation users in March 2021 continued to be quite high, at approximately 20% above March 2019, which had no impact from COVID-19. We believe that this level of strong user engagement will continue in FY21. Software sales in the first quarter ending June 30th, 2021 are expected to be below the same period of the previous fiscal year when lockdowns were widespread worldwide. But we expect the same or greater revenue year-on-year from the second quarter ending September 30th, 2021 onward. Regarding network services, we do not anticipate a significant increase in subscribers as was the case in the previous fiscal year, resulting from stay-at-home demand. But we do aim to maintain and expand the number of subscribers to PlayStation Plus, which increased throughout the previous fiscal year. In terms of costs, we plan to increase development, personnel, and other costs in our in-house studios by approximately 20 billion yen year-on-year as we further strengthen our in-house produced software. On the other hand, we plan to keep costs in all other areas at a level similar to the previous fiscal year, despite the increase in sales. To enhance our software offering, we intend to continue investing in partnering with external studios in addition to aggressively investing in our in-house studios. As I just mentioned, we aim to strengthen the PlayStation platform through action such as the recently announced partnership with the Heaven Entertainment Studios, which was established by Jade Raymond, the creator of the famous game Assassin's Creed, and our additional investment in Epic Games. Along with the rest of the Sonicgroup, we will also work to enhance the social and platform capabilities of games.
Next is the music segment. FY20 sales increased 11% year-on-year to 939.9 billion yen, mainly due to the growth of streaming revenue and Demon Slayer Kimetsu no Yaiba, the movie The Mugen Train, which was a blockbuster hit. Operating income increased a significant 45.7 billion yen year-on-year to 188.1 billion yen, chiefly due to the impact of the increased sales and recording of one-time gains of 11.9 billion yen from the transfer of businesses. In recorded music, streaming revenue for the fiscal year continued to grow at the high rate of approximately 22% year-on-year. The profit contribution from visual media and platform, which includes mobile game applications and anime, mainly in Japan, accounted for a little less than 30% of the operating income of the entire segment. FY21 sales are expected to increase 5% year-on-year to 990 billion yen, and operating income is expected to decrease 26.1 billion yen to 162 billion yen. The decrease in operating income is mainly due to a conservative view as to the profit contribution of mobile game applications this fiscal year, while the previous fiscal year had one-time gains and historic blockbuster hit Demon Slayer that I mentioned earlier. On the other hand, in the recorded music and music publishing businesses, we expect continued profit growth as we capitalize on the growth of streaming revenue. We are steadily improving our ability to discover and nurture artists and continuously create hits, and we aim to continue to increase our profitability going forward. Opportunities for investment in the music segment are steadily increasing, and we are aggressively pursuing them. To capture more of the growth in emerging markets, we recently announced the acquisition of Som Libre, an independent music label in Brazil. Like the acquisition of AWOL, an artist services business in the independent space that we announced in February, regulatory approval is necessary, but we believe both these transactions will contribute to the further growth of the music segment. Next is the picture segment. FY20 sales decreased a significant 25% year-on-year to 758.8 billion yen, chiefly due to a significant decrease in theatrical releases and delays in TV show productions and deliveries resulting from the impact of COVID-19. Despite the impact of the lower sales, operating income increased 12.3 billion yen year-on-year to 80.5 billion yen, mainly due to a significant decrease in marketing costs and strong home entertainment and television licensing revenues in motion pictures, as well as a decrease in portfolio review costs in media networks. FY21 sales are expected to increase a significant 50% year-on-year to 1,140 billion yen. This increase is mainly due to a resumption of theatrical releases in motion pictures and a recovery in TV productions and media networks. Operating income is expected to increase 2.5 billion yen year-on-year to 83 billion yen, chiefly due to the impact of the increase in sales for the entire segment, including license revenue for the popular U.S. TV series Seinfeld, partially offset by an increase in marketing costs associated with the reopening of theaters. In motion pictures, theaters in major U.S. cities are reopening, and from June, we plan to release into U.S. theaters sequels to hit films like Peter Rabbit and Hotel Transylvania. Theatrical releases remain important to Sony, but taking into account the crowded schedule of release post-theater reopening, we will be flexible when selecting the channel through which we will sell our product, depending on the content, scale, and timing of the works so as to maximize the long-term value of each work. In addition, license agreement negotiations for films and TV shows are proceeding smoothly against the backdrop of increasing demand for content. As we announced the other day, we have signed long-term license agreements on good terms with Netflix and Disney for U.S. distribution of our theatrical releases from 2022. Next is the Electronics Products and Solutions segment. FY20 sales decreased 4% year-on-year to 1,920.7 billion yen, mainly due to a decrease in unit sales, especially of digital cameras, and the impact of foreign exchange rates. Operating income increased a significant 51.9 billion yen year-on-year to 139.2 billion yen, mainly due to a reduction of operating costs, mainly in mobile communications, and an improvement in the product mix for TVs and other products, partially offset by the impact of the decrease in sales. FY21 sales are expected to be 2,260 billion yen, and operating income is expected to be 148 billion yen. Excluding the impact of the change in segmentation resulting from the recent organizational change, we expect that sales will increase 9% year-on-year, and operating income will increase 13.9 billion yen year-on-year. Throughout FY20, this segment was significantly impacted by intermittent disruptions in the supply chain of components caused by the various factors such as COVID-19. However, we were able to respond swiftly to these changes and secure a high level of profit. Moreover, the mobile communications business, which had been an issue for us, was able to record a large profit which exceeded our initial expectations. From this April, the businesses within EP&S have been combined into the new Sony Corporation. The operating environment remains unpredictable, but the new management team, which is comprised of people who helped manage through the difficult operating environment of the previous fiscal year, are expected to continue to manage this business with a high degree of resiliency to change.
Next is the Imaging and Sensing Solutions segment. fiscal year 20 sales decreased 5% year-on-year to 1,012.5 billion yen, primarily due to lower sales of image sensors for mobile. Operating income decreased a significant 89.7 billion yen year-on-year to 145.9 billion yen, primarily due to an increase in research and development expenses and depreciation, as well as the impact of the decrease in sales. Fiscal year 21 sales are expected to increase 12% year-on-year to 1,133 billion yen, and operating income is expected to decrease 5.9 billion yen to 140 billion yen. In fiscal year 21, we expect that our market share on a volume basis will return to a similar level as it was in the fiscal year ended March 31st, 2020, thanks to our efforts to expand our customer base in the mobile sensor business, or manage the business in a more proactive manner while keeping an eye on risk. We plan to increase research expenses in fiscal year 21 by approximately 15% or 25 billion yen year-on-year to expand the type of products we sell and to shift to higher value-added models from the fiscal year ending March 31st, 2023. We expect image sensor capital expenditures to be 285 billion yen, part of which was postponed from the previous fiscal year. We plan to shift to higher value-added products that leverage Sony's stack technology in preparation for an improvement in the product mix from fiscal year 22, and will concentrate our investment on production capacity necessary to produce them. The other day, we held a completion ceremony for our new Fab 5 building at our Nagasaki factory. Expansion of production capacity is progressing according to plan, and we'll build, expand, and equip facilities in line with the pace of expansion of our business going forward. Shortages of semiconductors have become an issue recently, but with the cooperation of our partners, we have already secured enough supply of logic semiconductors used in our image sensors to cover our production plan for this fiscal year. However, there is a possibility that the semiconductor shortage will be prolonged, so we are accelerating the shift to higher value-added products that we have been advancing heretofore. We are also continuing to proactively pursue mid to long-term initiatives in the automotive and 3D sensing areas, and will explain more details at the IR Day scheduled for next month. Last is the financial services segment. Fiscal year 20 financial services revenue increased a significant 28% year-on-year to 1,668.9 billion yen, primarily due to an increase in net gains on investments in the separate account at Sony Life Insurance, partially offset by a decrease in single premium insurance. Operating income increased significant 35 billion yen year-on-year to 164.6 billion yen, primarily due to an improvement in valuation gains and losses on securities at Sony Bank and a decline in the loss ratio for automobile insurance at Sony Assurance, partially offset by an impairment charge against long-lived assets in the nursing care business. New policy amount in force at Sony Life in fiscal 20 was below that of the previous fiscal year due to the impact of COVID-19, but it has trended higher year-on-year from the second quarter ended September 30th, 2020. Fiscal 21 financial services revenue is expected to decrease 16% to 1,400 billion yen, primarily because we do not incorporate into our forecast an increase in net gains on investments in the separate accounts at Sony Life resulting from strong market conditions, as was the case in the previous fiscal year. Operating income is expected to increase 5.4 billion yen to 170 billion yen, primarily due to an increase in policy amount in force at Sony Life. Now I would like to discuss the financial directions of fourth mid-range plan, which starts this fiscal year. In previous mid-range plans, we have prioritized improvement and enhancement of the profitability of each business, but in the fourth mid-range plan, we aim to grow both sales and profit. We will adopt adjusted EBITDA as the group key performance indicator for the fourth mid-range plan. EBITDA is a metric that enables us to confirm that all of the businesses in the Sony Group including financial services, which is now a wholly owned subsidiary, are expanding over the mid to long term through cycles of investment and return, and it is often used to calculate corporate value. Our target for the cumulative total of the new next three fiscal years is 4.3 trillion yen. For more details, including the definition of the adjusted EBITDA, please refer to page 23 of the presentation materials. Now I will update you on our capital allocation plan. During the third mid-range plan, we used the consolidated operating cash flow excluding the financial services segment and the cash we generated from asset sales to invest 1.2 trillion yen in capital expenditures, to invest 1.4 trillion yen in strategic investments, including share repurchases, and issue 170 billion yen in dividends. In the new mid-range plan, we have established a capital expenditure target of 1.5 trillion yen and a strategic investment target of 2 trillion yen or more, as we aim to grow our business over the long term beyond the duration of the plan. Regarding dividends, our policy is to increase dividends in a stable manner over the long term. We expect to fund our allocation of capital through consolidated operating cash flow excluding the financial services segment, including cash left over from before. If additional funds become necessary, we might also sell assets and borrow with a strict eye on financial discipline. Operating cash flow includes dividends from the financial services business, and we expect that the financial services business will contribute to the growth investment capability of the Sonígroup through a stable increase in its dividends as its own profit grows over the mid to long term. Lastly, I would like to touch upon share repurchases. Today, we announced the establishment of a facility to repurchase up to 200 billion yen of the shares of Sonígroup Corporation over the period of 1 year. In the previous fiscal year, we did not avail ourselves of the share repurchase facility we had in place because of a steady increase in growth investment opportunities and the price of our shares. But we continue to view share repurchases as a part of the strategic investment, and we will implement them in an opportune manner. This concludes my remarks.
Thank you very much. It was Mr. Totoki, the Executive Deputy President.
We would like to answer questions from investors and analysts. I will serve as the moderator. My name is Hayakawa with Finance and IR. The responders are Executive Deputy President, Chief Financial Officer, Senior Vice President Totoki, Senior Vice President in charge of Corporate Planning and Control and Finance and IR, Naomi Matsuoka, Senior Vice President, Senior General Manager, Global Accounting Division, Hirotoshi Korenaga. If you have a question, please press asterisk and 1, the number 1. We're going to call the questioner, and when your name is called, please start speaking. We'd like to confine the number of questions to 2 per person. In order to avoid feedback, should you ask a question, please turn down the volume of your peripheral equipment to 0. We'd like to have your cooperation. If your voice is severed because of the environment, in the interest of time, we'd like to move on to the next person who would like to ask your question. We'd like to have your understanding. If you'd like to cancel your request for a question, please press the asterisk and then number 2. So we'd like to begin a Q&A session. If you have a question, please press asterisk and then number 1. JP Morgan Securities, Aeda-san, please. Thank you. Aeda with JP Morgan. I have 2 questions, if I may. Question 1 about INSS. Well, wafer, the input and capacity, what's the track record, and also outlook about capacity at the end of the year. If you have the number, I will appreciate that. And relatedly, Totoki-san earlier on said fiscal 21, you have a good outlook, a prospect for recovery, for volume, but with respect to improvement of a product mix, what is your, view? In the second half, are you going to have a larger, products qualitatively? So if you have any prospect. Question 2, In the MRP4, the adjusted EBITDA, 4.3 trillion yen, the thinking around it, if possible, in this fiscal year, based on the plan, the adjusted EBITDA, what is it? And pre-tax profit, that's 900 billion plus, and D&A, that's 450 billion. So perhaps 1.4 or 1.5 trillion yen, but I would like to ask you about the number. If it's 1.4, 1.5 trillion yen, then in terms of math, in 3 years it will be flat, it appears. So in 3 years, the growth, or beyond that, how do you look at the growth? So in terms of adjusted EBITDA, with respect to the balance with the growth, if you have any message to the market, I'd be appreciative to hear that. Thank you for your question. 2 questions. The first question is with respect to INSS, the wafer input and the capacity, and product mix improvement prospect, qualitative point, in my understanding. And your second question, adjusted EBITDA, based on this fiscal year's plan, what would be the level of EBITDA? So first, to answer your first question, regarding capacity, in fiscal 20, in Q4, at the end of Q4, the master installation, it's about 139K. That was the capacity. And the previously it was 131K, so it's up. The plan was to start operating it in April, but because of earlier preparation, we started the operation partially. That's why we have this number. And in fiscal 21, at the end of Q1, it will be 141K in our prospect. So what about the increased capacity? Well, increased for the building for increase, that's just for some production lines. So that doesn't mean that there's going to be a huge increase in the capacity. With respect to the wafer input in for Q, the track record is it was 128K. That's average. Simple math. It was expected. And our in-house capacity is in full operation. And in fiscal 21, in Q1, the wafer input, the 3-month average is 138K. And again, in-house capacity is expected to be in full production. We have a lot of inquiries these days. In addition, in fiscal 21, in preparation for the shipment of new models of smartphone, we are increasing our production. With respect to the prospect of product mix improvement, in fiscal 21, in the second half of this fiscal year, 0.7, small products will pick up. And so when it picks up in fiscal 22, higher value added types will be launched. That is the prospect at this moment. So with respect to product mix improvement, that is the idea that we have. Also, about adjusted EBITDA, this is just a ballpark. Please understand it just approximation, but in fiscal 21, it should be 1.3 trillion yen in fiscal 21. But in a single year, evaluation of that in single year, given our mid and long-term plan, we should look at it. We should look at the total. So if you just look at a single year, launch something, that kind of a discussion should not be done, in my view. Thank you.
Now we'd like to entertain the next question. SMBC Nikko, Mr. Katsura, please. Thank you. I hope you can hear me. Yes. Thank you. Music is something I have one question about. And the second one, I have a question on semiconductor. In music, as Mr. Totoki explained, that the media and platform, the profit, about 30% of that is related to this Aniplex. But anyway, according to this year's plan, what is the assumption? They said that the more optimal solution will be chosen. But in this fiscal term, what's your philosophy and idea? That's my idea on this. The second question is related to semiconductor investment philosophy. For this fiscal term, as well the upcoming 3-year plan of investment, could you please, and that's what you have given us some of the ideas. But about 6 months ago, or maybe 3 months ago or so, compared to that timing, more active stance. You have shifted to more active investment. Could you please give us a background for that investment? By that investment, how that is the market share or the capacity share that you like to achieve? Well, in the details will be explained at the IR meeting with regard to the MRP 4. Thank you. Thank you for your question. Music, whether the percentage of media platform for 2020, about 30%. That's something we have indicated to you. When you break it down to that breakdown, naturally, the theater version of the Demon Slayer is a big hit. So in 2021, it doesn't happen again. And mobile game as well. The content was very good. So there could be deceleration in that area. And those factors, excluding those factors, and 11.9 billion yen is income from the sales of the business, transfer of business. Taking that into account, year on year, 14 billion yen or so is a reduction. So that is a reduction to be felt. So anyway, when you compare overall the income, of course, the other part will enjoy the growth. That is thanks to the increase of the revenue from the streaming. And that's how we see the growth of the profit. As to the INSS, this is the area last year, 2020, fiscal 2020, there was an original plan, the investment. And I explained to you earlier, but some of the investment plan was postponed to the future. As of now, 2022 and afterwards, there's a strong demand we expect. So in that sense, some of the capital investment, 2020 and afterwards, some are to be implemented as well. So this is 283 billion, 283 billion. And 2020, the volume share is recovered, and we are almost to achieve it. So 2022, further strength of ours will be achieved. In other words, we will get this profit and then the sales. And we need to have a capacity prepared to produce. So that's why we started to invest for the capacity building and additional facilities. And as of now, in the fourth term, the final year capacity and its size, we expect, it's not a simple increase of the capacity for investment, but rather we are shifting to the high value-added products. So process itself need to be increased and enhanced. Investment in there is quite voluminous. And then by enlarging the size, it might change. So when we talk about the relation between capacity and then investment is not a linear relationship. So we cannot specifically just talk about capacity because of that complexity. Thank you.
Next question, please. From Mizuho Securities, Nakane-san, please. Nakane speaking. Thank you. 2 questions. First, in the text about the games, What I wanted to ask, hardware, software, network, if you divide this, what would be the profit for each? And the backdrop, the contributing factor is the improvement in hardware. PS5 and peripherals may give this uplift. When the volume is increasing, the gross deficit may increase. That will push down, we thought, the level of profit. But the network profit is not included. What would you say? Second, R&D is 610 billion, which is a large increase. You talked about I and SNS, but any other areas that there will be an increase under MRP in the new MRP? Thank you very much for your questions. First, about the game and network service. I couldn't really hear you clearly, so let me confirm. We improved the profitability of hardware. When the PS5's unit sales increases, that may lower the profitability. Was that what you're asking? Including the peripherals, probably you could achieve the profitability. That's what I thought. Now, profitability, profit contribution of hardware in FY20, inclusive of the peripherals, is positive. That's what we have been saying. And then the amount of the contribution in this fiscal 21 will be about the same or even above the previous year's level. That's the assumption of the plan. Why is it the case? Compared to last year, PS5's profitability will improve. That's how we forecast. That's why this change will be brought about. Second question about R&D expense. Your question about the R&D cost. On a consolidated basis, as you say, 610 billion yen from the previous, compared to the previous year, it is an increase by more than 80 billion yen. Game network services, EP and S and I and SS, every segment increased. Game and network services, it's the development cost increased by 20 billion yen, and that had the impact. Also, INSS, 25 billion yen or so increase is expected, and the remainder will come from EP&S. Thank you.
Now we're running out of time, so the next question will be the last question. Morgan Stanley MFG, Ono-san. My name is Ono with Morgan. Thank you. First, well, this may overlap somewhat with Nakane-san's question. Game and network, 17.2 billion reduction in profit. The game development expense, that's about 20 billion. I think you said that in your comment. But the positive factors and negative factors in terms of scale, could you give us more hints? Add-on content, negative factor, game development, the in-house software, and also the hardware as related with Nakano-san's question. So that's my first question. Ono-san, if you could also give us your second question. My second question, EP&S, 13.9 billion reduction in profit. Well, if possible, by product category, the sequence, what are the items? If you could explain that. Thank you. Thank you for your questions. Now, with respect to game and network service, fiscal 21 reduction in profit, positive factors, negative factors, that's what you would like to know. Now, we're including some qualitative aspects. I would like to give you an answer. Number one, as I have been saying all along, with respect to hardware, basically, we are moving positively, the entire hardware. We ask you to look at it positively, and including investment in studio, the development of games, we're going to increase that. So that's a part of investment that will increase. And third-party software reduction in profit, we do anticipate it somewhat, but again, last fiscal year, first quarter, I think, it just increased dramatically because of stay-at-home demand last year. So I think we have to discount it. I think that's a reasonable way to look at it. So that's the way we should look at it. And the end result of our calculation is that. I think that is one way to look at it. Regarding currency, I think that should work positively. And EPNS, increase in profit by product category. Well, it's not all that complex from camera. The increased profit and the revenue are coming. Well, last year, because of a pandemic, the negative impact was given on the digital camera. And here we are on a path for recovery. And by country, it differs, but the pandemic, as it abates, there are strong products, and they will again grow. Thank you. Now, thank you. Now it's time to close it. We'd like to close the Sony Group Corporation's financial results briefing. Thank you for your participation today.